to move right on, and from one corporate voice to another, let's focus in on Quess Corp's numbers. Margins have improved. The revenues have grown by about 13%, although the profit performance has been flat. We have Mr. Ajit Isaac, who is the Chairman Managing Director, now joining in on the show to chat a little bit about the way forward and what the growth outlook is for Quess Corp. Thank you for taking time out, Mr. Isaac, and being with us on ETNOW. Tell us what exactly helped drive your top-line growth and give us a sense as to why profits were muted.
Morning, and happy to be with you today. The first thing is that Quess has delivered actually a strong set of numbers for the year ending March 2017, and the results are reflective of the management's goal of building long-term value for our investors. If you look at our numbers over a 5-year time frame, our growth has been about 7x, our EBITDA has been about 8 times, and PAT has grown by about 14 times. Similarly, if you look at our numbers for the last financial year, our revenue has grown by about 21% to about 4,157 crores. Our EBITDA has actually grown by about 47%, up to about 222 crores, up from about 151 crores for the last financial year. And PAT has grown to about 113 crores, which is up by about 40%. Also, in terms of our DSO has come down from what was 43 days to about 39 days. And in terms of M&A, we've completed 6 acquisitions, adding almost about 110 crores of EBITDA for the next financial year, which means on a base of 220 crores that we have this year, we're adding almost 50% EBITDA for the next year. In terms of quality of earnings for the last financial year, our margin has expanded by almost 96 basis points, up from about 4.6% to about 5.4%. Our cash collection has improved significantly. From minus 40 odd crores, we've improved it to about plus 70 crores. So that's a significant change in cash collection of the company. Our gearing has come down also to less than 1 on a debt equity basis, up from about what is effectively about 1.05. And in terms of new initiatives, we've got a few things coming up which will significantly improve earnings for the next year, like digitization of our operations. The board has recently approved a capital raising round of up to about 10%, which of course we will decide in the future of when to do it and what to do with it.
Right.
And we've also increased management bandwidth of the company over the last 2 to 3 months to absorb new growth. So all in all, it's been a good year for us. Profits have grown, top line has grown, margins have expanded, and more cash has been generated in the company.
Yeah, the sense that I get is that things are on track, and even when I'm glancing at your margins, it has come in pretty steady. Are you confident that you will better your margins?
Our goal is to be plus 6% as a EBITDA margin company. The newer acquisitions we've done are all in excess of 6%. Our existing business are also, expanding margins. For example, our people service business, which is our largest business, contributing almost about 2,300 crores out of the 4,100 crores of revenue that we've got, has expanded margins from 3.7 to 4.6%. Is expanding on margins, and we believe that we have the potential to further expand from where we are today.
What about Global Tech Solutions? That's performed well. What's the outlook over here, and will facility management continue to look muted?
Our technology solutions business, in that we have 2 or 3 different components. We have India's largest staffing company called Magna Infotech. We own a majority equity interest in Singapore's largest staffing company called Comtel, and another one in Canada called Mindwire and Brainhunter, which does almost 70 million of Canadian dollars. So all these businesses are visa independent businesses and not dependent on local labor laws, so to say, in terms of building revenue. So we are in a good place with each of these businesses. I think the noise that you hear in the sector about job losses are exaggerated in India, and it's not yet doomsday time as many would make it out to be. We believe that we have the potential to grow this business by about 20% at least year-on-year basis, with a further potential to increase margins up from about 7% where we are right now. In the facility space, last year was it grew lesser than expectations. Our growth was about 8 to 10%. This is a business that can grow by at least about 15 to 20% on a year-on-year basis. It was also partially due to the fact that we were reorganizing some of our accounts and dropping some of the lesser margin accounts and tail accounts. That exercise having been completed over the last year, this year we expect it to bump up in terms of both margins and growth. The first quarter is already looking good, and our pipeline suggests that we should be able to maintain a 20% growth line for this year.
Since you touched upon job losses, etc., there have been quite a few layoffs, at least when it comes to the IT sector as a whole, as we've been reading and talking to you about. And the services that you offer also cater to the IT sector. Will any sort of a slowdown there impact your performance?
We are not immune from the effects of an overall slowdown in the IT sector. If that slowdown takes place, I'm sure some of it will reflect on some of our numbers. But having said that, I think we should see this in perspective. In an industry that employs between 3.5 to 4 million people, almost between 5 to 10% of it are subject to performance appraisal related changes in their career. So if, let's say, about 10 to 30,000 people are being released right now, and which is really at the end of the performance appraisal cycle, and it coincides with that activity in every organization, if that amount of layoffs are taking place, it may also be related to performance-related issues and not absolutely related to industry downturn. So I think we should see this in context and perspective. My own understanding of the situation is that it's not as bad as it's made out to be. Technology is constantly resurgent. It's all the time creating new methods by which business processes can be delivered. So while digitization comes in, while it will take away one category of jobs, that will be replaced by a higher level of skills, and that's what the adjustment that organizations like us need to make to.
Let you go on that note, Mr. Isaac. Thank you for joining in on the show and giving us a sense of the segment-wise breakup, what the plans are for the company, as well as your margin outlook. The stock, though, a little bit tempered in today's session. Edelweiss's earnings coming in